Today I would like to talk about Xinyi Glass Holdings. Is one of the biggest glass manufacturer in China. They also sell the products worldwide, and they selling the architectural glass, as we can see here, for the buildings. But they also sell the automobile glass, which is a growing industry, of course, and they sell the float glass as well. So they have the interesting products, and it's an interesting company as well, because when we look at the chart, in the 5-year charts, it didn't happen much. It was up significant in 2021, about 300%, but then it dropped all the way down again, and it's from the all-time high, it's down 76%. So it looks interesting to maybe start a position, but we have to take a look at the financials to find out more. The first thing we can recognize about this company is a market cap of 29.24 billion Hong Kong dollar. So this is about $3.75 billion. So it's still a small company. It's not very huge, but it's a big player in the glass industry. And we can also see here they have a very high dividend yield of 9.83%. But I also think this dividend yield is not sustainable. So probably this dividend will be cut in the next years. So it will be lower than this. But we can take a look at the financials now to see if this is a good buy or if it's not a good buy. So let's take a look at the financial foundation. The first thing we are looking for is revenue growth over the last 5 years. So we can see here it was 16.26 billion in the year 2019, and in 2023 it's about 26.8 billion. So we have the increase, but we also have the decline of 2021. So that's not great, but it's still up over the 5 years, so it will be a check here. Now we are looking for free cash flow growth. So this is a very important number because the company pays their dividend with the free cash flow, and they also can buy back shares with the free cash flow. So it's very important for us. And we can say here their free cash flow did increase over the years. It nearly doubled. But we can also see the free cash flow was in the highest in 2021, and since then it decreased. So if it keeps going down, it's not great, but it's still up over the 5 years, so it's a check here as well. Now we are looking for the free cash flow yield over 4%. This also shows us the valuation of this company. So if it's under 4%, it could mean this company is overvalued. So we're going to take the free cash flow from the last year, 2.39, and then we're going to divide it with the market cap that we have here already. So this will give us a free cash flow yield. So the free cash flow yield is over 8%. So this is actually a very good number. 8.173%. This is actually a great number. It could mean this company is undervalued. But we also can see the dividend is higher than the free cash flow. So this means this dividend is not sustainable. So they probably will cut it because the free cash flow is less than the dividend yield. So they cannot really pay it with the free cash flow. It's a check here, and it's a good check as well. It's over 4%, so we like that. So now we're looking for debt to free cash flow ratio under 5. This means we can pay back the debt with our free cash flow in under 5 years. So it's a very important number because we don't like to have too much debt that we cannot pay back, because this can also mean that we could get the bankruptcy, because when we cannot pay back the debt, this is a big problem for us. So we will take a look here at the short-term debt first. It's about 5.26 billion. And then we're gonna adding the long-term debt as well. You can see here it's close to 3 billion, and then we're gonna divide it with the free cash flow that we had, 2.39. So this will give us a debt to free cash flow ratio. So we have this number here, 3.42. So this means in a little bit over 4 years, we can pay back the debt with our free cash flow. So it's a check here as well, and it's a good number, I think. So they are not looking too bad about the balance sheet. You can also see they have a little bit cash as well, 2.5 billion Hong Kong dollar. So it's not looking bad. But we can also see the cash on hand decreased over the years. So it was way higher before, but it's still a good number. The last thing we would like to see is shares outstanding decrease. This means that the company buys back their own shares. So especially when the company is already accomplished and they have a cheap valuation, we would like to see them buy back shares. So we can see here they did not buy back shares over the years, and it increased a little bit as well. So we don't really like to see that, especially when the company already looks cheap like this. We would like to see them buy back their own shares because this can increase the stock price. So it's not a check here, but the other 4 things looking good. I would like to add some bonus information about Xinyi Glass. So there's the other company named Xinyi Solar, and they produce solar glass. And Xinyi Glass is owning 23% of Xinyi Solar. So this is also interesting because solar energy is a growing industry, and this could mean that in the future this company could be more valuable. I would like to give my conclusion about this company. So let's start with the good things. I believe it's a high potential business. So they're selling glass, and I think this will still grow in the future. We always need to have glass for the buildings, for the cars. So it's a growing business. Also, I like the free cash flow yield. It's over 8%. This looks very good. It could mean that this company is undervalued. I also think it's a recovery play. So if the recession is gone and we will have the growing market again, then people will more buy cars and building more houses. So we would need more glass. And then this company could also recover and the stock price could go up again. So the negative thing to me is it's hard to understand the market position. So we don't really can understand how dominant this company is, how is the competition. So it's really hard to understand this. I also think the dividend will be cut. So the dividend is too high. They cannot really pay this with the free cash flow. And they also not have a stock buyback. This is also not so nice because we would like to see the stock buyback when the company is undervalued. The balance sheet is looking good, but it's not great. There are other Chinese companies who have better balance sheet, so they have more cash on hand and less debt. And obviously we have the China risk. So China is always has some risk and is often undervalued company. So we have to understand this as well. But this company has a lot of potential. So I also understand if people would like to invest in this company. So I hope you liked the video, and please don't forget to subscribe and like the video.